Happy Friday. Another volatile week for mortgage rates, but I'm happy to report that as we kick off this wet Friday, 30-year fix is sitting at 7.04%. And you may be saying, Eric, that's higher than last week's 7%. Why are you celebrating? And it comes down to the point at midweek, had we pulled up, interest rates were over 7.15. So the question becomes, what drove this volatility? And in turn, why did we see such a sharp reversal? So this week, let's cover on consumer price index, PPI, producer price index, and the talk in Washington around gold. And I ultimately want to close with some creative ideas to gain some additional engagement with prospective buyers over this weekend. So, first, let's dive into it. This week was highly anticipated on Wall Street, financial markets, you name it, around the release of the consumer price index report, inflation. And there were a ton of fears walking into the release of this report for the fact that prices were rising. And in turn, the fear was, hey, we're going to see some hotter than expected inflation data, which in turn was going to bring further question around, hey, when would the Fed start cutting rates again? Well, Wednesday came and gone, and yes, inflation was hotter than expected on both the headline number and the all important core number. And it was really pegged to energy, lodging away from home, and food, in home and out of home. And as we know, eggs, gosh, are the new luxury item, if you want to call it. It's no surprise that we saw those sharp rises in inflationary data. That said, on Wednesday alone, we saw massive swings in mortgage backed securities, which ultimately drove rates higher. And again, as I said earlier, the fear around, hey, what does this translate into when the Fed will start cutting again? Why we saw interest rates respond accordingly. Well, that information or that move was very short lived because we fast forward into yesterday, Thursday, and we got wholesale inflation producer price index, which, yes, at face value was higher, but components within that report that move over into PPE, personal consumption expenditures, were actually lower, which in turn we saw basically a reversal, which brought us to the flat reading we are here today. All that said, there is still a ton of question as to how this information is going to be digested by the Fed and what it means for Fed rate cuts going forward. Previous expectations were we should start seeing cuts in May. Now those estimates show September. And as before, it's really anyone's guess. But hey, we're going to bask in it. Market is seeing something that maybe we're not all picking up on, and we're going to run with it. The next, gold. A lot of talk right now in Washington around revaluing our gold holdings. So currently, gold is priced based on values from the 70s. So gold that's sitting in our reserves are priced at $42 an ounce. As we know right now, gold is trending around 2,900 an ounce. The prevailing thought is, hey, like other central banks across the world, if we were to revalue our gold holdings in today's dollars, all of a sudden there's billions, almost $1 trillion of liquidity that hits the market, which in turn would be great for mortgage backed securities amongst other asset classes. And it comes down to right now, one of the main concerns within mortgage backed securities is around the deficit spending. How we're financing our debt is issuance of treasuries. If all of a sudden we came up on close to $1 trillion with this revaluation of gold, we could see a very sharp decline on treasury coupons, specifically the 10-year, which in turn would translate to some very phenomenal mortgage pricing. So definitely something we're watching, financial markets are watching. No fully confirmed information on this yet, but obviously as info comes, we'll share. Lastly, tips for this weekend. Seller paid buy down. Yes, affordability is still a major concern, but seller paid buy downs are helping the affordability crunch. As always, if you need help running these numbers, we'd love the opportunity to assist. Stay dry. Happy Valentine's Day. Happy Friday, and let's make it a great weekend. Thank you.